All right, guys, bang, bang. I've got Darius here. Darius, everyone has been saying that the world is going to end, that we're headed to a recession, and then the GDP number just dropped and it absolutely blew away expectations. What the hell is going on?
Yeah, man. It kind of reminds me of the old school Mortal Kombat. You remember had like the finish him move. The GDP data and also the PC report that we got on Friday was kind of like the finish him for like the ultra bearish narrative. And so I think a lot of folks who have been, fighting this equity bull market, the bull market we've seen in credit year to date, I think a lot of folks are going to have to throw in the towel and capitulate in the second half of the year. So let's start with this first chart here. Where we show real GDP accelerating and beating consensus expectations in the second quarter. Real GDP came in at 2.4% on a quarter over quarter annualized basis. That's the highest print we've seen since the fourth quarter of last year. If you go down to the third panel in this chart where we show the I component, so gross private domestic investment, that number accelerated to 4.8% on a quarter over quarter annualized basis and contributed 100 basis points to that headline GDP figure of 2.4%. That's the highest number we've seen since the first quarter of last year. So economy's doing quite fine.
Now, when we go and we look at June numbers specifically, there's some nuanced data here that's kind of telling a story that I think reinforces the macro GDP number. What are you seeing in the June data?
Yeah, absolutely. So if you look at this chart here where we show industrial production, capacity utilization, manufacturing and trade inventories, but specifically want to focus your eyes to the bottom two panels where we show durable goods new orders as well as core capital goods new orders. And just by way of reference, when you see these charts from us, the blue bars indicate the quarter over quarter or the 3-month annualized rate of change, and then the red line just shows the year over year rate of change. But we're primarily focused on the sequential, the 3-month annualized rates of change here, 42 macro, because we believe that's where more market information lies. But again, if you go back and you look at these, the June durable goods print came in at 32.4% 3-month annualized. That's the highest number we've seen since September of 2020. And then core capital goods new orders came in at 5.7% on a 3-month annualized basis. So that's the highest number we've seen since August of 2022. So, wherever you slice and dice it, whether it be GDP, whether it be durable goods, capital goods, new orders, the U.S. economy very much looked like it's growing quite robustly.
Now, you can look at all of the actual goods themselves, but if you just go look at what consumers are doing with their pocketbooks, they're spending.
Yeah.
What are we
Yeah.
seeing here?
Yeah, that's what we've been saying, man. And look, the U.S. economy is a consumption-oriented economy, right? We know that 68% of GDP is consumer spending. And on Friday, we got the June PCE report, which I happen to find is this, outside of the jobs report, arguably the most important economic statistic that comes out on a monthly basis. And when you look at the top panel there, where we show a headline PCE, so real personal consumption expenditures, they accelerated to 2.9% in June. That's a 3-month high. And it was driven primarily by a rebound in goods consumption. Where we saw real goods PCE accelerate to 5.4% on a 3-month annualized basis. That is also a 3-month high.
Now, when we look at income growth, I think this is one of these metrics where like real wages have been down for like 2 years because of inflation being so high. And obviously people start to politicize those numbers. But when we look at income growth, that seems to be telling a pretty positive story as well.
Yeah, 100%, man. So real wages, and let me just take a quick second to take a step back there. Real wages have been negative in terms of just specifically wages, or at least they had been prior to 2023 for a while. But the reality is consumer income has not been negative because, again, we're seeing total growth in employment. It's not just wages. You also have employment as well. You have government transfers and other avenues in terms of supporting income growth. And so if you look at income growth specifically in the PC report, so again, we get consumer spending in that report. We get consumer income in that report, and we also get inflation as it relates to the consumer economy in that report. So let's start with the income here. So personal income, this is nominal employee compensation. So it's the broadest, most nominal measure of income that we receive from the labor market on a monthly basis. That number accelerated to 6.2%, 3-month annualized in June. That's the highest number we've seen since September of last year. And that really matters because, in nominal employee compensation or employee compensation is right around 60 or a little bit over 60% of total income growth. Another interesting statistic I'll throw out from this particular chart here, if you go down to the fourth panel there, where we show personal interest income, that number accelerated to 8.8% 3-month annualized in June. That's the highest number we've seen since January of this year. So when you put those two factors together, nominal employee compensation, interest income, you're talking about 70% of consumer income is growing somewhere between 6 and 9% on a 3-month annualized basis. That just does not sound like an economy that's anywhere near a recession.
Now, when we start thinking about the U.S. economy more broadly, this idea of it being resilient keeps coming up, or like a resilient economy theme. Describe a little bit what some of the factors that feed into that are.
Yeah, absolutely, man. So you and I have been talking about this for almost a year now. We created the theme in August of 2022. It's August of 2023. We've added some things to the list, but primarily most of the stuff was readily available if you were doing the research back last summer to understand that the U.S. economy is likely to remain resilient for longer than the average investor understood. And the reality is, so there's 8 factors that we see as independent factors, but all being very relevant. There's number 1 is near record cash on household balance sheets. Number 2, you have near record cash on corporate balance sheets. Number 3, you have private sector income and wealth have outpaced inflation on a structural basis. So clearly, the big issue is, okay, inflation is very high. We had the negative wage growth that you cited earlier. But the reality is, since the inflation episode started, going back a couple of years ago, we're still seeing income and measures of wealth, like household net worth, for instance. Those numbers have actually grown faster than inflation has on a cumulative basis. Number 4, we've limited credit cycle vulnerabilities. I mean, I'm sure you've heard this 1,000 times. How credit card debt, blink, credit card debt, blink. But I'll throw a couple statistics at you, just specifically as it relates to consumer leverage. So if you look at household debt relative to nominal disposable personal income, so that's the broadest measure of income we have as consumers here in the U.S. economy, that number is 85.5% in June. That's exactly the same as the trailing 10-year mean. So there's been no sort of degradation in terms of consumers getting over levered in any stretch. And even when you look at it specifically as it relates to credit card debt, that number is right around 4.9% as a percent of nominal disposable personal income. That's below the trailing 10-year mean. So you could take all those tweets about credit card debt and stuff, which is what I said a year ago, and light it in a dumpster fire with all the other bad economic statistics that people keep trying to cite with this faulty bearish narrative. The reality is we got a few more here to get through. So we have limited exposure to the volatile manufacturing sector. Manufacturing sector is way more volatile relative to the services sector. It accounts for about 98% of net job loss in a recession on a median basis, going all the way back to the post-war U.S. economy. We have long and variable lags, at least according to our estimates, based on what the percent of debt that's been sort of termed out both within the household sector and also in the corporate sector as well. You also have this, these record spreads between not record, but near record spreads between, let's say a marginal mortgage relative to the effective mortgage rate that everyone's paying, or relative to the yield on corporate credit instruments relative to the coupon that the corporates are actually paying. So what's happening is folks aren't going to the market to buy a new house. They're not going to the market to issue new debt. And so ultimately what it means is that monetary policy is just going to take longer to really hit the economy because we're seeing that stasis develop. And lastly, we got Bidenomics. This is something we saw in last Thursday's GDP report. But if you look at government investment, is growing plus 11% on a 3-month annualized basis. It's also growing plus 11% on a year-over-year basis as well. So it's been pretty persistent, that trend of government investment. And then lastly, you have labor hoarding, which is something we've talked about on the program as well. Labor hoarding in the sense that it's been very difficult because we've seen this structural decline in the total labor force relative to prior to the pandemic. It's been very difficult for U.S. firms to attract and retain talent. And so as a function of that, they've probably just been more unwilling to fire people in this particular business cycle than they otherwise would have, given how much, kind of tightening we've seen thus far.
Bidenomics is still the most hilarious title of all time because it feels like it's used both for positive and negative descriptions. But regardless of what people have from a perspective, it's just the policies have led to the results, and you can judge them for yourself. When we think about transitory Goldilocks, I know that's something that you've been thinking a lot about. What are we seeing here?
Yeah, absolutely. So you go back to January of this year when I identified the transitory Goldilocks theme. It was based on our realization that, hey, look, this immaculate disinflation is real, right? We had the resilient U.S. economy theme since going back to last summer, but what became pretty clear to us, in January, and I think we were among other investors who kind of came up with that at the same time. I shout out my man Bob Elliott over at Limited. Hey, we actually are experiencing this immaculate disinflation because what tends not to happen in the U.S. business cycle is inflation breaking down before a recession. But that's exactly what we've seen. So on Friday, we've gotten PCE, the PCE report. Within that, we get the PCE deflator. So this is the broadest measure of inflation specifically for the household sector in the U.S. economy, or for the consumers in terms of consumer spending. And so there's 4 statistics that are really important in that particular report. I'll start with the 1, 2, 3, 4, the 5th panel, which is core PCE inflation. So that's the Fed's preferred measure of inflation. This is the one that the Fed cares about the most. That number decelerated to 3.3% on a 3-month annualized basis. That's the lowest print we've seen since February of 2021. So that's pretty robust. And what's likely to happen in the coming months is that the year-over-year numbers are going to continue to chase the 3-month annualized rates of change lower. That should certainly happen as well for supercore PC inflation, which is the bottom panel there. So supercore PC inflation is core services, PC inflation ex housing. This is the one that Powell keeps citing at all these FOMC press conferences. And that number decelerated to 3.2% on a 3-month annualized basis. That's the blue bars in these charts. That's the lowest print we've seen since July of last year. We're also seeing it on a broad base measure as well. So if you kind of go back up a couple of panels where we show median PCE and trim mean PCE, those numbers came in at 3.8 and 3.4% respectively. Both of those were the lowest numbers we've seen since August of 2021. So we're making significant progress as it relates to, getting inflation under control. And it's coming from, some pretty important avenues as well. If you go to the next slide.
Now, when we look at things in the private sector, you've got a couple of panels here. What's going on?
Yeah, so this chart here, just following up on this immaculate disinflation discussion here. So we'll get obviously the resilient economy. That's the first collection of charts. Second collection of charts here is just kind of updating investors on where we are in this immaculate disinflation process. And I'll draw your eye specifically to the bottom panel in this chart where we show the private sector employment cost index. And so that's the broadest measure of wages and salaries, or at least on a quarterly basis. And that's the one the Fed kind of really cares about to kind of anchor monetary policy on. And so, historically, we were kind of trending around 2.5%. That's pretty much, anything right around 2.5% is pretty much consistent with 2% inflation. So we're clearly very north of that, but we are making decent progress. If you look at it on a quarter over quarter annualized basis, the private sector employment cost index decelerated to 4.1% in the second quarter. That's the lowest print we've seen since the second quarter of 2021. So if we continue to make this kind of progress, it's definitely going to call into question whether or not the Fed is going to be able to continue to hike interest rates in September. Don't forget, we got 2 more CPI reports between now and the September meeting. I think we have 1 more PCE report, and then we have 2 more jobs reports. So, they're going to be busy in terms of interpreting this data.
Now, when you start looking out kind of at what the Fed is seeing here, we obviously got the interest rate hike. Is this something where they can just keep hiking forever, or are they pretty much saying to themselves, look, we get the green light because the economy's strong and we can go higher? Is it wait, we're going to over-rotate? How are you thinking about this?
Yeah, it's a great question, man. So I think they're done for now. They may go on what may ultimately feel like elongated pause, because I don't think between now and the September meeting, FOMC meeting, that they're going to get any data that has a material change in terms of its flavor. We have this immaculate disinflation. It's probably going to slow down the pace of the immaculate disinflation. But ultimately, as we show on chart 8, I'm actually quite concerned that, by the time we roll the clock 3 to 6 months from now, beyond the Fed meeting, I think that the narrative of inflation can very much shift from immaculate disinflation to sticky inflation, and that might ultimately kind of cause the Fed to get off its high horse and implement another rate hike or so. So we'll see. I don't know I don't really have a strong opinion on that. But what I do have a strong opinion on is that, as we show here in chart 8, if we continue to see this rally in food and energy prices, we have WTI on the left chart there. It just recently broke out to bullish from the perspective of our volatility adjusted momentum signal. We have agriculture, which has been bullish for maybe a little bit over a month now, relative to our volatility adjusted momentum signal. If those bullish VAMs, kind of conditions persist for the next few months, we will see another surge in inflation, just similar to kind of what we saw in the first half of 2022. So that's something that's concerning me. But another thing that's concerning me, I think we might have talked about this on the program as well, which is immaculate disinflation was probably going to run out at some point anyway in the second half of the year, just based on where we are in the U.S. business cycle and the likelihood that it's very unlikely that we see inflation return back to 2% prior to a recession. We do believe inflation is heading back to 2%. But we also ultimately think that we got to go through recession to get to that. So if you play the clock forward in terms of how the market narrative might change between now and let's call it the end of the year, right now it's saying economy is resilient. We got immaculate disinflation. You put those 2 things together, we got transitory Goldilocks. I think between now and the end of the year, some point in Q4, maybe even it spills over into Q1. But I think the narrative around the resilient economy will dissipate, and sort of and part of the reason the narrative around the driving force behind why the narrative on the economy being resilient will dissipate is because the narrative surrounding immaculate disinflation will change. And if we shift back to something that looks like sticky inflation, and ultimately a Fed that has to do more tightening that gets pushed the economy into a recession, that's going to cause the resilient economy narrative to unwind. So I think 6 months from now, it's probably going to be a very different feel in asset markets. It could be sooner. I don't have a crystal ball on like when that actually is going to come up, but I do believe, when we get into the fourth quarter, some of the data is probably going to look a little bit different than it does today.
When you look at asset prices, you see the Fed's actions. We go into the end of the year. There's this whole thought process of like, May hits and go away. Is that true? Or do you think asset prices got a shot through the rest of the year?
Oh, I think they do. I think we're going to make all-time highs in the SPY. We said this last week a couple times, and based on the reality, based on in our analysis of this data, it's very unlikely we see a significant change in the conditions of these kind of themes. Immaculate disinflation, resilient U.S. economy equals transitory Goldilocks. I think if we have another 3 months of that, we are going to make all-time highs in the SPY. I mean, you just see what happened over the last 3 months. Could very easily add another 200 S&P points in a matter of a couple of months. So I do believe all-time highs in the S&P are very likely, but that doesn't necessarily mean it's the start of a new raging bull market, because again, I still think the market is going to have to price in at some point between now and the first half of next year, into the first half of next year, something what we call a phase 2 credit cycle downturn, which is the process of the market, trying to find the lows, trying to find a low in earnings and corporate profitability in a recession. And the correction in valuations that we typically see, that allows different businesses, different investors to capitalize, businesses and take over new businesses. That process is months. If in our view, it's probably months away. At the earliest, probably 4 or 5 months away. At the latest, probably 7, 8 months away. And so if you think about, how much time that is in risk management terms, think about where we were 4 to 5 months ago in pricing terms, 7, 8 months ago in pricing terms, and you can kind of roll the clock forward on that.
When we have to look out over 2024, obviously the economy is, some people think it's going to go into a recession at the end of this year, beginning of next year. There's this positive kind of undertone to it. Housing prices is the last thing I want to talk about real quick. What we've seen is they were pretty resilient, and now there starts to be some softening in it. How much of economic pain could potentially just be lagging a lot of the interest rate decisions versus some of the data points we talked about today you think can overpower that stuff, and actually we're on our way back kind of up as an economy, and the Fed we'll give it quits and walk away?
No, that's a phenomenal question, man. So
Darius, we've been doing this for how long? Of course, I ask phenomenal questions.
That's true. Yeah, I think you're one of the world's best, man, and I appreciate being on with your community. So in terms of answering the question, I think so. We believe a recession is still the most likely probability. Our model since November of last year has been centered on the 6-month interval between Q4 of 2023 and Q1 of 2024 as when a recession is most likely to start. So that's still our baseline scenario. We'd have to go through Q1 of 2024 for us to now cast our way out of that. And so in terms of like the resiliency that we've seen since then, this wasn't an impulse. There was not like a new thing that created the resiliency. It's that the economy was always resilient. It was just being underreported. And the change in the market price year to date has really forced the mainstream media to stop doing whatever the hell it is that they're doing all day and actually acknowledge the fact that the economy has been resilient. This is the stuff we do every single day. It seems boring, trying to figure out what the 3-month annualized rate of change of durable goods is boring as hell, but you got to do it in order to get these themes right.
Where can we send people to find you on the internet or find out more about 42 Macro?
Yeah, I appreciate it, man. So definitely come check us out, 42macro.com. 42 Macro Weather is my Twitter handle. Pretty active on there as well. So definitely give us a drop.
I appreciate you. I learned something every time. We'll do it again.
Appreciate you, man. Thank you so much.